So maybe you're looking to buy stock in Visa, or perhaps you hold Visa stock and you're wondering whether or not to sell. Well, I've got the answers for you today here, Finance with JCL. So welcome everyone, thank you for joining me, and Visa is the topic of the day. So have we missed the boat, or is it still a good investment? Now we're going to start off by looking at rule number one, which is don't lose money. Now the financial health, first of all, the current ratio, absolutely lovely, nice and high. It's always above that benchmark of 1, and the debt to equity is below that benchmark of 1. The financial health looks really good. 18 billion of cash on the balance sheet, which is almost the same as the debt amount. So I'd say rule one is satisfied here. You're unlikely to lose money in terms of company failure, but of course you could lose money if the company is overvalued and therefore stock returns to a more fundamental base level. So we need to look at that element of it later on. So stay tuned for that. But first of all, just have a look at that trend. So I think in the Western world, the trend is accelerated by COVID away from cash. So Visa is well placed for more contactless payments on cards. And also, of course, the increased online commerce as well, which you then need a card to pay for unless you use an alternative like PayPal. And that actually leads us to the negative, really. And the main negative is going to be that increased digital competition for new and more nimble organisations. That's where we're at. We just have a quick look at that 10-year history. You can see here 9 billion revenue 2021, over doubled in that time, up to 21 billion now. It was 23 billion in 2019, but looks like there have been some small impacts from the pandemic. Gross margins really high consistently around that sort of 80% mark, and net incomes in recent years has grown to over $10 billion per year. Very high earnings per share there, around that kind of $5 a share mark, which is much higher than it was 10 years ago. And the other thing to note here is the dividend, which was 15 cents. That's been going up now at 124, so that's a significant multiple increase in the dividend per share over that time. And the payout ratio is still 25%, so you'd be happy for them paying their $2.50 a share dividend. They could easily afford that. Number of shares, 2.8 billion, down to 2.2 billion, so they've been doing share buybacks. So it's really interesting. The dividends increase, they're buying back shares, and they're growing the business at the same time. Quite a cool combination. Nice free cash flow there, 11 billion, not much capex spending because, of course, it's more sort of digital infrastructure rather than physical. We look at their margins as well. These are incredible, pretty much above 40% for most years. In 2019, above 50%. So this is an incredible business, and that return on equity is really high. So yeah, this is probably why they haven't increased the dividend as much as they could do, because they're actually making more money by reinvesting that money back into the business, as shown by that return on equity figure. So it's very effective management with that high return on equity, really high net margin, incredibly effective management. And of course, they've got some power there. If they have too much competition, they have got the ability to price in a different way because their margin is so strong. It's a 500 billion company. Can you double your money in this in 5 years? Can you see this as 1 trillion? I can't definitely say yes, but I wouldn't rule it out. I think there is a world where this becomes a 1 trillion company. If you look at these ratios here, trailing PE is 50, very high trailing PE for a company of this size. Forward PE is 35. And we look at the analysis here, they could be growing at 19% a year for the next 5 years. All the analysts pretty much are saying it's a buy. This source, which is a different set of analysts, you're looking at 16.5% a year. You're definitely paying a premium for this company. So that's valuation method number one, but there's two other kind of valuation methods we could use here, and not just looking at the PE, which is a relatively simplistic method. So the second one, we can have a look at the Simply Wall Street, and they're saying they're probably slightly overvalued, but in that sort of fair value, sort of roughly right landing. There isn't a margin of safety. I don't think you need a margin of safety of Visa in terms of chance of failure. So I think there's always no chance of them failing. So I think the only thing you'd want is a margin of safety in terms of the valuation, so you could buy it at a discount and make a quicker return, perhaps. If we have a look at that price chart in the last 5 years, there was a great opportunity at the peak pandemic in 2020 when it was trading at round about 150. Now that could have been a really good buying opportunity there. But actually, just before that, it peaked at 210 or so. We're actually at 245 now. So it's even grown past its pre-pandemic situation. You go back to 2017, look, it's trading at 75. There's been a massive run, the company here. You can actually see if you zoom out here, look at that, it's just straight up. Looking at the growth rates from analysts, is 20% a year growth enough to justify the current valuation? In terms, I'm not sure. Now look at the surprise percentages on earnings history. They do tend to outperform what the analysts say. So perhaps it's going to be more like 25 or 25% maybe per year. Start sounding a bit better in terms of their growth. There's probably a discounted cash flow to do here because this is a sort of large, stable, cash generative business. So a discounted cash flow is appropriate. Okay, so on my discounted cash flow template, we are going to simulate 5 years of growth, I think, because if we're looking at relatively high growth rates, then simulate that 10 years ahead, you're going to end up with an absolutely gigantic company. I think 5 years is where we've got some analyst estimates. Well, let's say you're after 10% a year, and the terminal multiple, so the PE in 5 years' time, I'm going to use a 35. And the market cap today is 538 billion, and we're at 244 share price. So we've got a number of shares here at 2204, and we've got two different numbers here on Yahoo actually. And I'm going to use the implied shares outstanding number of 2130 because that is quite similar to the Morningstar one. And starting free cash flow, I'm just going to use the most recent figure from Morningstar. That does feel like a good starting point. So we've got the inputs in. Now, calculations, I think in the best case scenario, you could say they grow at 25% a year, their earnings for 5 years. And what that gives us is the following output. So in terms of the terminal value, what we think we could sell them at in 5 years' time, discounted back today's cash, we're looking at $350 a share. And then if you add in the per share discounted cash generated by the business, then we're looking at intrinsic value of around about $400. So if Visa is priced at 400, 396, let's round it, let's call it 400, then you would make 10% year return on the basis of these assumptions. And that is a discount of 38%. If you're really bullish, 25% a year, forward P 35, then you could definitely argue that this is undervalued and a good buy. But look at that raw free cash flow. Are we saying Visa's going to treble their free cash flow on a non-discounted basis in 5 years? Yeah, that seems unlikely. What have they done in the last 5 years? They've doubled it. Go back again, they've probably doubled it again. So perhaps we should temper this down a bit. So 15% is doubling their free cash flow in 5 years. That seems a bit more plausible. And if they're growing at 15% a year, are you going to be selling them at terminal multiple of 35? Probably going to be selling them at 30, perhaps a little bit lower. And also we're going to be looking at MasterCard soon. So I'll leave a link to MasterCard once that video is done, which is coming straight after this at the end of this as well. So this gives us actually these perhaps slightly more realistic levels, intrinsic value per share of 234, which is basically where we're at. So just by going changing the growth rate down a bit and that terminal multiple, we're suddenly now at a position where they are bang on fair value with no margin of safety for a 10% a year return. That feels about right to me. That was kind of the instinct when we looked at those PEs originally. And it also ties in a bit with that Simply Wall Street, although just use that as a guide rather than the exact answer. So what do we find? I think this is perhaps a more realistic answer. I think if you buy Visa now, you're looking at 10% a year return. That's pretty good, and could well beat the S&P 500 because that's at such highs now that perhaps it won't grow quite as fast as it has been for the next few years. But with all the money that's been printed, who knows? It may keep growing because everyone's trying to guess what's going to happen. But I think you're good for 10% a year on this one. That is my assessment. That's the analysis from me. And if you want to buy it, there's some links in the description below where you can sign up with some brokers in order to buy it. And for my portfolio, my £1 million investment challenge, which is one of the main parts of this channel where I try and hit £1 million of my investment account over the long term. So we're talking like 30 years, hopefully quicker. This isn't a buy for me. In fact, I recently sold stock in Visa. It's actually a very small position that I had, and it was so diluted in terms of how big it was compared to the portfolio. It wasn't really going to have any impact on the portfolio, even if it doubled. And it was pretty much at record highs. And I thought, now's the time to take that and redeploy it when there are some cheaper opportunities in the market. So, for example, Walgreens was been trading at a discounted price recently, in my opinion. I think I get best than 10% year return on them compared to Visa. Really interested to know if you've got Visa, what you think their fair value is. Please do drop me a comment below, and yeah, be interested to see what you think, and also whether you think they're best than MasterCard, which is the next review that I'll link in once I've done that analysis for you. So thanks very much for joining me. I'll see you on the next one.